We're live with the world's greatest investor. Warren Buffett joins us for a special one-hour event. His take on the markets.
Stocks ought to be higher every 10 years.
Immigration reform.
Your zip code still is a very big predictor of your destiny.
Coke's compensation plan.
I know we'll have some very constructive discussions with Coca-Cola.
The minimum wage debate.
We have not come close to fulfilling the potential of this country.
The nation's tax system.
No other group has come down as much percentage-wise as corporations.
And why he's standing by Burger King. The final hour, Squawk Box, live with Warren Buffett, begins right now.
Welcome back to Squawk Box here on CNBC, first in business worldwide. I'm Becky Quick along with Andrew Ross Sorkin and Steve Leisman. Joe is off this week. We are thrilled this morning to have a very special guest joining us. Berkshire Hathaway's chairman and CEO Warren Buffett is here on set at CNBC. He's going to be with us for the next hour. Warren, good morning. It's great to see you.
Good morning.
I know we have a lot to talk about, but I also know that you have some news that you'd like to talk about. You've also brought along a very special guest with you, Larry Van Tile. Larry, nice to meet you. Thank you for coming.
Thank you, Becky.
Why don't you two tell us your news?
Well, I do have some good news, and it involves Larry. Yesterday, we signed an agreement, Berkshire Hathaway signed an agreement to buy Van Tile Auto, and which is owned and run by Larry, and we've known each other for some time. Larry has 78 dealerships, volume of about $9 billion.
Car dealerships.
Car dealerships. Yeah, well, we're planes, trains, and automobiles now. Right. I mean, it took a little while, but NetJets, BNSF, and Van Tile. And, you know, he has the class operation of the business. I think you're fifth largest among the group dealers. And we hope that number moves up. And I should let Larry do the talking.
Larry, thanks for joining us today. It's great to see you. Congratulations on the deal. This is a company I know that you built up with your father. Is that right?
That's right. 62 years.
And your father started the first auto dealership. How did you grow from there?
Well, we expanded with partners. Our model is to give opportunities, entrepreneurial opportunities, grow people from within, and give them an opportunity to be a minority stakeholder in a car dealership.
And this is a business, we should say, that's a privately held business. Is there a valuation on the deal, on how much you paid, Warren?
There's a valuation.
Can you tell us?
I can tell you that the sales are about $9 billion, but I can't give you a number.
$9 billion in sales. Why did you get into this? Why did you get interested in this particular business?
Well, Larry had actually come to me 6 or 7 years ago, and we didn't really get well acquainted at that time. But at that time, I was not a buyer. Then, I don't know, 6 months ago or thereabouts, Larry came by again. He'd been to our annual meetings, and he knew he wanted to do business with Berkshire. And this is just a very, very good operation. He has this partnership approach that he has worked extraordinarily well. He's just kept adding dealerships over the years. There's an insurance company involved. There's real estate involved. And he wanted to be sure that Van Tile ended up in a permanent home. And so we worked out a deal very quickly. Took a while to write up the contract, but we made the basic deal very fast.
Warren, you said it yourself, planes, trains, and automobiles. What is it about transport that attracts you?
Well, it really isn't the transport. It's the specifics. I mean, we've gone a long time without getting into automobiles. But Larry's got an operation that we think can be scaled up a lot from where it is. He's got the management. He's got a format that really works.
Does that require investment from you, from Berkshire?
Pardon me?
Does that require a lot of investment from you to scale it up?
Yeah, sure. If we, I fully expect we'll buy a lot more dealerships over time, and
so this would be used as a vehicle to perhaps roll up a lot more dealerships,
absolutely.
Independent and otherwise. I mean, could you see a big acquisition of another dealership company?
We could see anything that makes sense, and you know, Larry's going to be the judge as to which ones make sense, but he operates with what, 6 or 7 manufacturers now, and his reputation, if you talk to, I did talk to Mark Fields at Ford, everybody knows that Larry's got the best operation, and people will want to join it. And we've got the capital, so we're off to the races.
We had Mike Jackson from AutoNation on earlier this morning. I suppose that this is a direct competitor to AutoNation. Is that right, Larry?
It is.
So, go ahead, Steve.
No. What is it about this industry right now? It's not a very consolidated industry. It's very little pieces out there. What kind of market share do you think it's possible for a single operator to hold in the dealership business?
Well, the large groups, so the AutoNations and Mr. Penske and others have about 8%, including ours.
Altogether?
Altogether.
Because AutoNation, I calculated this morning, is 1.7% by itself.
Yeah, so
That's
huge opportunities for consolidation of the market. Right. Huge opportunities.
See, there are about 17,000 dealers in the country. Interestingly enough, if you go back 30 or 40 years, it was in the 30,000s. I mean, there's been, but 17,000 possibilities out there. So we will hear, Larry hears all the time from dealers. I mean, with 17,000 units out there, there's somebody that wants to sell all the time. Then the question is which ones make sense. And that's Larry's job. My job is to write the checks.
Larry, we did talk with Mike Jackson today, and he was talking about what he sees as, he says he's pretty optimistic about the auto sales business over the next several years. He's looking at probably 16.5 million in sales that he expects on an annualized basis this year. He sees that stepping up about 3% to 17 million next year. How does that match with what you see?
I agree, and it's a waterfall for the rest of our business. So our used car sales, our service business, our parts business, collision business, it affects all areas of our business. So it's a win-win.
You think the consumer is feeling fairly healthy? Because there have been some questions about that recently.
You know, I do. The technology certainly is motivating him to want to go buy a new vehicle. It's changed and it continues to change. So whether it's gasoline, hybrid, techs in your car, whatever it is, it's just keeping people motivated to come out and buy new products.
Can you speak to being a seller to Warren Buffett? The reason I ask is there are lots of family-owned companies who have sold over the years to Warren. You tried to sell the company to him 6 years ago, or that was just the sort of first approach?
I went to talk to him to see how he saw our business, and we are a fully integrated business, so we have auto auctions and other things. So I wanted to see if he had an interest or if he'd thought about it, and so that's where we started our conversations. And it only takes one conversation with him to say, this is a guy that I want to talk to be the custodian of our business for a lifetime. And because I've been in it for as long as I have been, it's important to me and my team on who we're with, and you can't be with anybody better than this.
Would have you ever sold the company to anybody else? There are founders who say it's this or nothing.
We've had plenty of opportunities to do that. So I actually, when I went and talked to Mr. Buffett this last time, I said, I want to sell to Berkshire. I want to do business with Berkshire.
Okay, and then the question is there a discount? It's long been told, Warren, you know this, that people want to do business with you and they're willing to sell to you for maybe slightly less than they'd sell to somebody else because of what they think you will do as a steward of the company.
That's true, and if you take the long view, and that's what we do, he's absolutely, again, clearly the person that you should talk to if you take the long view, and that's what we do, is take the long view.
Warren, the last story I did about dealerships was they were closing them down.
Well, they've been reduced from 30
so
something.
You're buying into a business that's going like this. I mean, why it's not a growth business.
Well, cars aren't going like that. Dealerships maybe.
Dealerships are.
That means every dealership is going to sell more cars on average. So the pattern has changed, but the fundamental demand for cars has not gone down.
So you're coming in to consolidate in a consolidating business, and
yeah,
that
the average dealership will do a lot more business now than it did 30 or 40 years ago in terms of units.
Warren, you have said in the past that you like to do deals in cash, although you have been known to occasionally issue Berkshire stock if it's something like Burlington Northern. Is this an all-cash deal?
It's a cash deal.
And with $9 billion in sales, that's a big company. How does this?
It would be on the Fortune 500 all by itself. So when we get this done, we will now own 9.5 companies that would be on the Fortune 500 if individual companies. So that leaves us only 490.5 to go.
This company, though, material to, I mean, you don't have to disclose the price of this particular company because I'm assuming the size of it is smaller than, I don't know what the minimum would be for you to actually disclose. AutoNation, by the way, I was looking, is worth about $6 billion. So I don't know where, and you're number 5 relative to?
Yes.
What is AutoNation? Number what?
AutoNation's number 1.
Yeah.
So I don't know where that.
Temporarily.
When you look at what's been happening with gas prices, Larry, that has been a huge boom for consumers. Mike Jackson this morning said, you know, he was surprised. You don't expect to see gas prices down below $3 a gallon again. What does that do to sales? What does it do to consumers' taste as gas prices come down?
Well, I think both the combination of the increased miles per gallon that all the new products are getting and the lower gas prices is a boon. And people are going back to SUVs, full-size trucks, high-performance engines because they get better miles per gallon and the gas is cheaper, so it's nice.
When do you expect the consumer to go into this replacement cycle that everybody's been waiting for? Has it begun already? Is that why we're at 17 million units now? And I mean, how many cars out there that are on the road longer than they should be?
Well, if you stand in our service departments, the average mileage of a car coming in our service departments is 70,000 miles. So that's the highest it's been that I can remember all my life, and I've been in this business for 40-plus years myself, right? So there's a lot of old vehicles out there that still need to be replaced. So a lot of future out there.
So can I just get your view on where we go from here? Is 17 million the right number of units per year? Do you have a higher forecast than that?
I believe there'll be higher numbers. I think we're going to gradually work our way up to 18, 19 million. But it's a nice flow. It's a nice move because you can. Pardon me?
Not by next year?
No.
Yeah.
No, I'd say within the next 3 years, 4 years.
We have a little bit of breaking news. I just want to jump in, and maybe Warren can speak to this as well. The CEO of Allianz, the owner of PIMCO, stepping down this morning. The board resolving that he will step down. They're replacing him, and there seems to be a handful of switches going on here. Since you are here, Warren, what did you make of the PIMCO news last week with Bill Gross? What do you make of Allianz? How should we think about all of this?
It's huge news. The two may be connected. They may not. I don't know anything. I have no information other than what I've read in the paper. But it's a big story.
Were you surprised a founder like a Bill Gross would actually leave his firm or get kicked out of his firm?
Yeah. I mean, you know, a lot has been written about it. Now, my guess is there's even more that will be written about it, but I don't know anything on it.
Let me ask you a different question, actually. You have a lot of founders who work in your portfolio. Have you ever gotten in a situation where the founder, you got to a point where you just said, you know what, I love you, I thought I loved you, and I don't love you anymore?
I can't think of one. There may have been one, but I can't think of one. We don't have any retirement age, and so sometimes when you know, they get in their 70s, maybe in their 80s. I've had to tell them that, you know, their time is up. But I can't think of anybody that was a founder that we had to terminate in 50 years.
Do you and any of your businesses or any of your pension plans have any money with PIMCO?
No, not that I know of. And there are a couple of utilities we have that have pension funds that they're hands off with, and it's conceivable. But we run them, almost all of the pension funds.
Does a change like this, would it be something that would make you wary of keeping money with a manager like that? No,
I would assume that PIMCO has got all kinds of professionals there that are managing money. I would not change myself just because Bill Gross left. I mean, if I was happy with the personnel at PIMCO. But we manage all of our pensions pretty much internally, except for the ones connected with the utility business. And we're all equities anyway, so we don't have any bonds in our pension funds.
None at all?
Not the ones we manage. There might be one or two someplace, but...
Did you know that?
That's fascinating.
Yeah, well, equities are going to do better than bonds over time now. Maybe bonds...
100%?
100%, yeah.
But what about a guy who's 65? And about
yeah, but he's
we have enough cash there to we're paying out money.
He's running a self-funding pension. I mean,
self-funding pension, right? It's not.
Yeah.
It's not an
Warren, what do you think
amazing.
of Bill Gross's record, though? He's known as a legendary investor. I don't know how well you know him, and I don't know what you thought just about his track record over time.
Well, I don't know him well, but I do know him, and certainly what I know about his record is it's been terrific, and it's not easy to run, you know, hundreds of billions or maybe trillions of dollars. That's a real task. So to have a good record And it may have gotten more difficult as the numbers got larger. I don't know. Certainly that's true in equities. There's no question about that being the situation in equities. But his record had to be. He didn't attract that money just on his personality.
Right. Right.
I have a car question for you, car dealership question, because there's a story in the paper today. We talked to Mike Jackson about it before. Sort of this whole subprime lending issue and whether it is an issue. Apparently, there's some investigations going on into it. Do you see it either? I mean, I doubt you'll say you see it at your firm, but do you see it in the industry? Is there aggressive practices that people need to be worried about?
No. No, it's a very small percentage of the business. I think they learned from last time not to go do that again. And if you go back and look at the history of car papers, subprime or otherwise, it's probably been one of the best performing papers ever through thick and thin. So I don't see it as an issue.
And that's because I think what we know economically, right, is that people pay off their car loans before even they pay off their house, because the car loan and the car means getting to work, whereas you have an option, if you should get into those dire straits.
We discussed the importance of actually providing subprime loans to some people because you want a second chance, and you need, for the economy, if you want these people to get jobs and be able to take their kids to school and do the things that they need to do, it's important. So
that's right.
Warren,
it's a bit of a complicated issue.
Are there places like subprime where you're reaching and trying to find some yield these days?
No. That doesn't mean we wouldn't. We've owned junk bonds maybe 2 or 3 different times. I mean, gone heavily into them. And we would do it again if we liked the math of them. But we don't own any now.
What do you see when you look at the bond market today, the U.S. Treasury at 240?
Well, I don't start salivating, I'll put it that way. No, I mean, you're going to do better than 240 if you own equities over a long period of time. And so if you're talking about 240 for 10 years, I would just love to take a bet, on equities.
Why is everybody doing it?
Well, I think maybe the Fed has a little to do with it. I mean, you look at monetary policies around the world. I mean, you get. Thank heavens you don't live in Germany and get 1% on the German 10-year. So it's really an unusual phenomenon. I don't pretend to understand it. I mean, the level of interest rates around the world, it's pretty extraordinary. And if you'd asked me whether you could keep this up for this period and not have inflation, all kinds of things, I clearly don't understand it. Fortunately, I don't have to understand it. I mean, I'm in a business where I don't really have to understand why interest rates are 240, or what they're going to do tomorrow. It doesn't really make any difference. We're buying this business to own, 100 years, and there'll be periods when interest rates are high and low, and autos are this. It's a basically good business with a terrific guy running it, and that's the decision.
Larry, we want to thank you very much for joining us today and offer you congratulations.
Thank you very much.
Again, Larry Van Tile, who is the newest member of the Berkshire Hathaway family. When we come back, we'll be talking more with Warren Buffett about what's been happening with the stock market and its recent wobbles, the fight against Ebola, plus how is LeBron James? How is he helping LeBron James build sports' most powerful business empire? Right now, though, take a look at the futures this morning. After a big down day yesterday, a drop of more than 200 points for the Dow. We see some green arrows, but these are not major bounce backs after such a big drop yesterday. Right now, the Dow futures up by about 28 points above fair value. S&P futures up by 4 points. Squawk Box will be right back. Welcome back, everybody. We are joined once again by our special guest today, Warren Buffett. And Warren, it's a great time to have you here because there are so many concerns about what's been happening in the stock market. Yesterday alone, we saw the Dow down by about 230 points. There have been a lot of days recently where volatility seems to be creeping back in and where investors certainly seem a little more nervous. What do you think about where we've come, where stock prices stand right now, and where we're headed?
Well, we bought a business yesterday, and we would have bought it if the market had been up 200 points or down 200 points, or if the market had been up 1,000 the previous week or down 1,000. If you're buying a business to own, if you're buying a McDonald's franchise in your hometown, the idea of what the market does in any given day, it's just meaningless. What you really have to look at is where you expect the business to be 5 or 10 or 20 years from now. And that's what people do when they buy farms. It's what they do when they buy apartment houses. It's the way they look at any transaction except for stocks. And the reason is because you can look at stock prices minute by minute. And that should be an advantage, but many people turn it into a disadvantage. So we actually bought a few stocks yesterday, but we bought the business yesterday too. And if you told me that the market was going to go down 500 points next week, I would have bought those same businesses and stocks yesterday. I don't know how to tell what the market's going to do. I do know how to pick out reasonable businesses to own over a long period of time. And a lot of people do, incidentally.
Did you buy those stocks yesterday because the market was down so significantly?
Well, that helps. I mean, I like buying it as it goes down. And the more it goes down, the more I like to buy.
So you waited until you saw the market drop and then you put the buy orders in?
I just start buying, but when it goes down, I will be more aggressive as the stocks go down. I mean, the stocks I was buying yesterday, I hope go down today. I'll put it that way. And I hope they go down next week, and I hope they go down the week after. Nothing's going wrong with the companies.
Are those stocks that you were buying yesterday, are they new companies that you're investing in, or are they companies that you already own stakes in?
Well, you're getting close to the bone on that one. They're companies you'd be familiar with. That's as far as I'll go. But the answer, you know,
Sounds like a little of both.
If you like to buy a business, if you're buying groceries, you like it when prices go down next week, and you like it if they go down further the next week. And if you were buying an apartment house and you could buy one, and then you bought a similar one at a cheaper price, you'd like that.
Although there are times when the business is not what you think it is.
Well,
that's like a Tesco.
If you make a mistake. No, if you make a mistake.
When you're talking about groceries reminds me of Tesco, though.
Yeah, well, Tesco, we definitely made a mistake. I made a mistake on that. Wasn't anybody else made it. Yeah, that was a huge mistake by me. But I'm going to make mistakes. But I'm not going to make mistakes because I buy businesses I like as they go down in price. I'm just going to be wrong sometimes on the facts. But the idea of buying a stock because it's gone up, you know, it, to me, is just totally anathema.
Warren, there's two things going on here when I hear you talking. Listen, lots, but I always find it fascinating. You're making a fundamental judgment on a company.
It's a business judgment.
The concept, but you also have a feeling about where the market's going to be a year from now, where the economy is going to be a year from now. You have this fundamental idea that it goes up over time.
Yeah, well, it has in 1776, so I don't want to start changing now. Just look around you. I mean, there wasn't anything here in 1776. All of this is profit. Where we're sitting, Manhattan that I just left, it was nothing. So over time, you know, values appreciate. There's no question about that. Not for every single entity, but just take the Dow Jones average. You know, I mean, it was well under 100, and well, it was under 100 during a time when I was alive.
But so many Americans look at the stock market and they feel burned. They feel burned from 1999, 2000, the 2001 tech bubble crash, and they feel burned from what happened in 2008. And fundamentally, they feel like the stock market is not the place to rely on, to have that kind of confidence that you have in the market.
Well, but 2008 was a great time to buy stocks. I mean, anybody that owned a cross-section of American business over the last 10 years, 20 years, 30 years, 40 years, 50 years, 60 years, has done fine. Now, if they think they can dance in and out, you know, and buy and sell stocks, I mean, you know, they ought to head for Las Vegas. I mean, they can't do that. But what they can do is determine that there's a number of solid American businesses, a great number of them, and if you own a cross-section of them, and particularly if you buy them over time, you basically can't lose. But if you think you can buy stocks and pick out whether this stock is going to go up next week or next month, or the market is, you're in a fool's game.
So how do you react when you hear the statistics that we had, I think it was a couple days ago, the percentage of Americans who own stocks declining? Now it's below 50%.
Well, if they own stocks that are declining, they've come in when they get other people are excited about stocks, and then they leave when.
No, the percentage of Americans who actually own the percentage of Americans who own stocks has dropped. There aren't as many Americans who own it. Is that?
You know, that everybody shouldn't own stocks. A lot of people aren't psychologically suited to own something that bobs around in price all the time. They will do the wrong thing. They will get excited when they go up, and they'll get depressed when they go down. And if they are that psychological nature, they're going to get killed.
We had Ray Dalio on the program yesterday.
Yeah, I saw him.
And he made a comment about the economy and perhaps the markets, suggesting that things are going to be good. But he said only really for the next 18 months or 2 years. I don't know, you know, what was defining that threshold for him. But that's somewhat long term. It's not long term like 10, 20, 30 years.
I don't have
what do you think
idea whether he's right. I just have no notion what 18 months is going to look like. And I never had. I didn't know on September 10th, 2001, what was going to happen the next day. I didn't know on December 6th, 1941, what was going to happen the next day. I don't think anybody does. But the question is whether I can do intelligent things not knowing what's going to happen next day or next week or next month or next year. And you can do it. You can do it buying farms. You can do it buying apartment houses. You can do it buying a dry cleaning business someplace. You're buying businesses when you buy stocks. And if you look at that as a business and forget about stock quotations, most people would be better off if they, the person that did the best in Berkshire Hathaway was the person that bought it 50 years ago and never looked at the stock subsequently and never talked to a stockbroker.
Can we ask you about some news that came out yesterday from Coca-Cola? The company came out and revised its plan for what it will be paying its managers in terms of equity, in terms of options, in terms of shares that they'd be issuing. And I know that this is a plan that you told us earlier this year you had abstained from voting on. You didn't agree with the plan, but you didn't want to vote no against Coke. What do you think of the new plan that they've put forth?
I think the new plan makes great sense. They're not reducing the amount that they pay. I mean, so a lot of people will get cash instead of stock. But I think Maria Elena Messina, they call her Mel, she wrote a letter, which I think is a superb letter that's up on the internet. And she used the word precious in describing the stock. And that's the way I look at it. I look at Berkshire stock as precious. I look at Coke stock as precious. And they re-examined the cost to the company in terms of giving up shares and which people would be motivated by shares and which ones wouldn't. And they changed the mix to performance shares. So they actually went from the top quartile among their comparison group.
In terms of what they were paying out?
In terms of the shares. And by 2016, they'll be in the bottom quartile. Now, that's a big movement. Coke is the same company that 10 years or so ago, when all of American industry was ignoring the FASB, who said that it was preferable to expense stock options. There were 2 out of the S&P 500 that elected to expense them, even though the FASB said that was the preferable treatment. Coke was the one that made a change. And they just thought it through, and they decided it was the right thing to do, and that's what they did in this case. And like I say, Mel, who heads the comp committee, she's been terrific on this in terms of thinking through what are we trying to accomplish with the options, and what's the cost to the shareholders, and she weighed all the variables. And she came up with a terrific plan, so I tip my hat to him.
David Winters was the first one who had come up with some complaints about this plan. He was very vocal about it. In fact, he actually sold his shares in Berkshire Hathaway after you abstained.
He didn't
from
like the Coke plan. That's an interesting
Because he didn't like the Coke plan. He was on the closing bell yesterday, and I'd like to hear what he said about this plan.
The comp plan was a bamboozle, and this new release, is an improvement, but there's more to go to improve Coke's margins. We deserve, as Coca-Cola shareholders, to have the best CEO in the slot. And the current CEO is the one who delivered a plan that was massively dilutive, that they told the world that they had all this support, and in fact, they didn't. So I think that's a problem, because trust is the basic essence of investing.
Warren, what do you think about that?
Well, I don't think I'll ask David to speak at my funeral. I think it's remarkable what Coke did. They took something that had gone out to the public, and they said, did we really do this in exactly the right way? And they decided no, and they didn't do it through gritted teeth or anything of the sort. And Mel went to work. She talked to other companies as to what they'd done. She looked at burn rates. She talked to me. And she came up with something that was totally logical from a shareholder standpoint and from the standpoint of motivating employees. So I tip my hat to her, and David is doing something else with his anatomy to her.
Warren, you'll remember...
I just want to interrupt real quick. We did have a big drop in claims to 287.
Oh, jobless claims, which just hit the wire.
Claims. I know it's not the lowest we've seen, but it's gone the other way and is now remaining firmly below that 300,000 mark, and that could be seen by the market as another good sign for the jobs report.
Yeah, down 8,000 to an adjusted 287,000.
287.
Yeah.
Okay.
Let me ask you this, Warren. At the time that you abstained, you will remember, I'm sure you have not forgotten, that there was criticism. There were people who wanted you to vote against it, to affirmatively say that you were upset about this. Do you think now that the abstention helped get Coke to this place? Do you think had you voted against it, they would have had their backs up against it? Sort of take us through what you think happened.
I thought at the time the abstention was the right thing to do because it did express disapproval with it. It didn't, but I also said at the same time I thought Coke had a terrific management and they have terrific people and terrific board of directors, which I believe. So the abstention carried the message, and but there was no need to go to war or anything of the sort. These were perfectly reasonable people. They'll sit down and talk with you, and you can talk about the objectives of a compensation plan. What's the best way of getting it? Why is Coke maybe peculiar in some ways about their particular business operation? They made nothing but sense, and so I think it would have been wrong to vote against it. We had some shareholders talk about suing us because I abstained from voting. I mean, I just welcome him doing it. I'd like to have a little side bet with him on a suit. But, somebody else might have voted against it, but I don't see any reason to do that.
Right.
You like the people you're working with. These are people that are managing, in effect, $17 billion of Berkshire money. I mean, you don't want to be in an adversarial arrangement, but you also want to be able to speak your opinion if you have it.
So you trust these people? You don't have you don't think they have a credibility problem the way David Winters is out there?
They have zero credibility problem. I mean, the board, the comp committee, the CEO, all said, how could we make this plan better in terms of both motivating employees and conserving shares? It couldn't be better.
Warren, they did make a point of saying yesterday that they had made these changes after having conversations with many shareholders, including you. They specifically named you. How much of a seat did you have at the table? How involved were you with these changes?
Well, only when they asked me. But I had two conversations with Muhtar, and I had, as I remember, two conversations with Mel. And but they were not adversarial in any way, shape, or form. I admire both those people terrifically. I think you've got exactly the right person in both slots there. So they listened. I sent them some material that I'd written in the past about using stock as a compensation. They read them. I mean, I feel as good about my Coke investment as I've ever felt. I'll put it that way.
Warren, I feel like I won that lunch with you because it's only random that I'm here this morning and you're here. So I want some investment advice here. You won't give us companies. When you look into the U.S. economy and the way the global economy is changing, what sectors interest you? Where do you see interesting change where somebody brings you a company in that sector you're interested in?
Well, Larry came and talked to me a few months ago and said, he'd really like to join Berkshire Hathaway. And I understood enough about auto dealerships, and particularly his operation, to think that that's a good business for Berkshire to be in for the next 50 years. Going to planes and trains, I mean, the same thing happened with the Burlington Northern Santa Fe 6 or 7 years ago. We look at opportunities as they come along, and we try to figure out whether we can understand the long-term economic prospects of the business. A lot of times the answer is no. Then we forget it. But we're not making any judgment about where the market's going, or we're not looking at any macro factors. My partner, Charlie Munger, and I have been working together now 55 years. We've talked about every business you can imagine and stocks. We have never had one decision that involved a macro factor. It just doesn't come up. I mean, if I talk to Charlie about the Alta Link, which is something we're going to buy up in Alberta, or just anything, we don't get into macro. It just doesn't make any difference. We do decide whether we think we know where that business will be in 10 years or 20 years, and we know what we'll pay in terms of valuation. But we really don't care whether the Fed is going to increase interest rates 100 basis points or 200 basis points next week.
It's like a dagger in my heart, Warren. But let me ask you about the energy sector. If you're into the automobiles and
we are just delicately breaking into U.S. programming. We love to listen to what Mr. Buffett has to say, and we'll cross back to
Warren Buffett speaking out earlier this morning on Squawk Box Live, discussing a new acquisition and how he's investing these days. Andrew Ross Sorkin joins us this morning from HQ with some highlights. Hey, Andrew.
Hey, Carl. What a morning it was. Carl. Warren brought us a surprise this morning, a transaction, Berkshire Hathaway buying a large car dealership, Van Tile, talking about how that deal got done. Take a listen to this.
Larry came by again. He'd been to our annual meetings, and he knew he wanted to do business with Berkshire, and this is just a very, very good operation. He has this partnership approach that he has worked extraordinarily well. He's just kept adding dealerships over the years. There's an insurance company involved. There's real estate involved, and he wanted to be sure that Van Tile ended up in a permanent home, and so we worked out a deal very quickly.
We also talked about a number of other subjects in the news. Specifically, we talked about Coca-Cola changing their pay plan for executives that had come under a lot of criticism. He had abstained from the vote earlier in the year. He had been criticized for that abstention. Here's what he had to say about the shift in what Coca-Cola has now done to respond to shareholders.
The new plan makes great sense. They're not reducing the amount that they pay. I mean, so a lot of people will get cash instead of stock. They re-examined the cost to the company in terms of giving up shares, and which people would be motivated by shares and which ones wouldn't, and they changed the mix to performance shares.
And finally, we talked about another hot-button issue, and that is tax inversion. Specifically, we talked about this Burger King transaction with Tim Hortons that will move Burger King, make them domiciled in Canada. Warren Buffett helping to finance that deal. We asked him whether that deal was being led by taxes or being pushed by taxes, and whether it was patriotic.
There was all this material written about how tax-motivated this purchase might be. All kinds of comment. I did not read one article anyplace, never, where anybody looked up and saw what Burger King was paying in taxes. How much was Burger King paying in federal income taxes in the last 3 years? The highest figure. Nobody knows, because all they know is it must be a tax deal. The highest number in the last 3 years that Burger King paid in taxes was $30 million. Now, this is an $11 billion deal. Anybody can imagine paying $11 billion for a business because something is paying $30 million in federal income taxes. It was not a tax-motivated deal.
Carl, I was going to show you a clip of also what Warren Buffett had to say about the stock market. But you know what? He said about the stock market. He said the same thing he's always said, which is that he still thinks things, and the United States in particular, are going up, 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 and up. And even if there's a blip along the way, he sees it only getting better. That's what we have for you this morning.
I love that moment. He talks about buying See's Candy in 72 and says if you're going to own it for 10, 20, 30, 40, 50, 60 years, longer time horizon than a lot of us have, that's for sure.
Steve Leisman had different data throughout the day, and Warren Buffett said, I don't really care about this data. All I care about is what's going to happen 20, 30, 40 years from now. So,
Andrew, thanks for sticking around.
Absolutely.
Good to see you. Andrew Ross Sorkin back at HQ.
Let's get more now on what Berkshire's dealership deal means for the broader industry. Phil LeBeau in Chicago. So, Phil, now Warren Buffett is in the car business.
Yeah, and that's because it's a very lucrative business, Sarah. Let's take a look at the deal for Berkshire Hathaway Automotive. That's going to be the new name for the new company. Berkshire is buying the Van Tile Group. What's the Van Tile Group? Well, it's only the 5th largest auto dealership group in the country. 78 dealer partnerships. So they have the majority ownership in those 78 dealerships. They also have private partners in those dealerships. So Berkshire's buying the majority ownership there. $8 billion in revenue last year. And as I mentioned, the 5th largest dealership group. A lot of people are saying, well, is the auto industry near peak sales? Is it possible it's going to be going into a downturn? Listen to what Warren Buffett had to say about that this morning on Squawk Box.
Cars aren't going like that. Dealerships may.
Dealerships
yeah,
are.
That means every dealership is going to sell more cars on average. The pattern has changed, but the fundamental demand for cars is not going down. The average dealership will do a lot more business now than it did 30 or 40 years ago in terms of units.
And I mentioned earlier, dealerships are incredibly profitable, and you might be saying, well, how profitable? Well, their average return on investment, or return on equity, I should say, in 2013, 29%. That's basically doubled over the last 5 years, and that's for the average dealership in this country. And when you look at where they're making their money, a lot of people look at the showroom and they say, well, they're making money off that new car they're selling. Yes, they're making some money there, but the real money is in the back end. The biggest auto dealership profits come from the service department and used car sales, and they go hand in hand. The more used cars they sell, the more likely they are to have that particular customer come in to have the vehicle serviced. The average auto dealer made just over $920,000 pre-tax profit last year. Not surprisingly, when you take a look at the auto dealership stocks over the last 3 years, you'll notice the biggest move there is from Group 1, but all of the auto dealership stocks have really had a decent move over the last 3 years. It's a little hard to tell at the bottom there because they're being outsized there. What is that, Lithia? That's showing the huge return there. But the bottom line is this, guys. There are fewer auto dealerships, and they're great cash flow generators. And as a result, Warren Buffett's looking at this saying, you know what? They're not going anywhere. They're going to be around for years to come. That's the place to make some money.
You know, Phil, I'm still staggered by the margins we were talking about earlier in the week for the Ford pickup truck, the F-150. Just remind us what Ford makes on that.
Well, that's because they're selling that to the dealership. Average profit for Ford is between $8,000 and $10,000 per truck. Now, the dealership profit is not going to be $8,000 to $10,000 per truck. However, we should point out, if you have a dealership that is selling upscale luxury vehicles, well, then your profits per vehicle sold are going to be much greater than the mass market ones. And when you look at the overall pie, if you will, Simon, the average new vehicle sales, they generate about 15 to 20% of the profits for a dealership.
Fascinating stuff. High margins. Phil, thank you. Phil LeBeau there with the Buffett deal this morning.